Hello and welcome everybody. Welcome to the last Sectors Made Simple webinar of 2021. It's a pleasure to be here with you all, ready to share lots of amazing information all about this past year in the market. 2021 was an eventful year for all of us, both at Sectors Made Simple, in the country, and the stock market. And there's a lot for us to unpack. So last Friday was all about the Sectors Made Simple side. So what we've been up to here at Sectors Made Simple and the changes and advancements we've made in the past year to help you invest simpler. So if you're here from YouTube Suggested, or if you're not familiar with who we are at Sectors Made Simple, I recommend going to take a look at that webinar to show you all that we have to offer both subscribers and non-subscribers alike. Today, though, is all about the market. Today, I want to focus on the stock market, and I want to look at the changes, namely to sector relative strength. Taking sector exchange traded funds, or ETFs, and using them as a way of tracking and seeing changes in the market. So today, I want to do exactly that. We're going to go month by month, look at who our sector leaders were, price changes, current events, and more in our effort to try and find what changed in the world of sector rotation throughout 2021, as well as some things that you should keep an eye on moving into 2022. So let's get straight into it, because there is so much for us to go over today. Alrighty, disclaimer, I'm going to talk about investments, equities, and returns. All of this is educational purposes. We are looking at historical results here. We are not saying that historical results will tell you that you're going to make money in the future. That's not how things work like this. So past results can never guarantee future performance, so please always do your own research prior to making any investment decisions. I don't think you need me to tell you, well, let me move my face over here. There we go. I don't think you need me to tell you that 2021 was a crazy year of ups and downs in the market. We saw significant social and economic changes as a nation, but also as the globe. We have in the US a new president, widespread COVID vaccination, global supply chain disruptions thanks to COVID, but also thanks to some ships causing a little bit of a little sticky situation in the middle of the Suez Canal, extremely high inflation, enhanced unemployment benefits ending, and the rise of COVID variants, and so much more. So today, let's review a year in the market through the lens of sectors. So to show these changes over time, what we'll be doing is we're going to be looking at general market volatility and monthly inflation. This is going to be our weather forecast of what was the weather like for whatever we were doing. Then we're going to get into the nitty-gritty and talk a little bit about how sector ETFs prices changed month by month. Then we're going to talk about sector leadership. Sector leadership and price oftentimes go hand in hand, but not always. So today we're going to take a look at when they went hand in hand and when they didn't. Then we're also going to talk about major news events that have shaped the market that we saw in 2021. And lastly, we're going to talk about what to keep an eye on moving into the new year, 2022. Let's get started with market volatility. Market volatility is our way of saying how confused are investors. It's not saying that high volatility means big losses. It's not saying that low volatility means huge gains. Volatility doesn't care about direction. It just cares about how many people agree. So the price may be going ban, that is volatile. If it's just a flat line, not volatile. So this is what the graph for market volatility, as seen by what's called the VIX, the CBOE Volatility Index, VIX. This starts off at the very beginning of January 2021 and ends yesterday, December 20th of 2021. Over the year, we saw numerous spikes in volatility. But how big is big? On January 27th, we saw a high of 37.21, and on March 16th, very briefly, we saw a low of 14.25. Now, keep in mind, a stable VIX volatility is anything less than 15. Anything above that is considered to be slightly volatile, and the higher from 15 we go, the more volatile it is. Now, these spikes may seem huge if we're just looking at the graph. But let's put things into perspective here. Before we start to say how big is big, let's go back really quickly and let's look at what happened to the VIX volatility last year. So we're going to go from 1/1/20 to 1/1/21, and we'll make things look about the same. There we go. This is an ETF. This is not VIX itself. Give me VIX. There's the VIX. There we go. So what we see here is last year's volatility. We said that the highest point this year was 37.21. Last year, the high was 85.47 when all of the initial lockdowns began. When we put it into context, this big spike in volatility is really not that big. And with that, what we can really see is that for the most part, volatility was reasonable through 2021 compared to 2020. But above all, our average VIX is still 20. We are in an average, a more than volatile average, which is notable. So let's unpack this a little bit. Again, on average, our market volatility was close to 20. So while this is significantly lower than 2020's high of 85.47, the year's lowest volatility is also higher. 2020 did start off with a VIX of 11, a very stable market. And immediately as lockdowns began and this whole issue that we've been in for the past year and a half really kicked off, the market panicked. Volatility spiked, and while it did recover over the course of the year, by no means was it perfect. So using a VIX of 15 or below as a signal of a stable market, let's see if 2021 was stable comparatively. It wasn't. While, yes, I did say that there was a day that the volatility fell below 15. At no point during all of 2021 did the volatility end the trading day below 15. Every single day in the market this year was above average volatility, above the normal volatility. As I said earlier, keep in mind that high volatility does not mean there are big gains or losses. You can have extremely high volatility and have no price change at all. Because all volatility cares about is how big are the bigs or how low are the lows and how fast is it happening. Yes, high volatility might mean the stock market's taking off, and yes, high volatility, like in the case of March of 2020, means the market just decided to go to Magic Mountain and plummets. Both of those can be high volatility, just as a seesaw bouncing up and down can be volatile as well. Now, That's volatility. And we can see that volatility in 2021 was high. But that's not the only thing that was high in 2021. While volatility was high, inflation was higher. Inflation we often think of as, I have $1. How much can this dollar buy me? When there is a period of high inflation, that means that that dollar is going to be worth less and less and less over time. That sounds like a bad thing, right? We want our money to be worth something. But we also want that pressure. The Federal Reserve, the people that determine our money and what it should be worth, want it to be worth a little bit more or a little bit less every day. Because if you know that your dollar is not going to be worth $1 tomorrow, you're more likely to spend that today. That's how the Federal Reserve and the organizations responsible for keeping our economy healthy decide or influence us to spend money. They drive inflation up so that our money is worth less and less every day, and we're more encouraged to go out and spend it today because it's not going to be worth as much tomorrow. I like to call this the Chipotle index because my way of knowing how bad inflation is when I go to Chipotle, I look at the prices on the board, and every time I go to Chipotle, the prices are just taken off. My $7 steak burrito with guacamole is now $11.50 or something, and it hurts, but I also love guacamole and Chipotle burritos. Not a sponsor. Chipotle, sponsor me. So what I'm showing on screen right now is volatility over the past 4 years, my apologies. Starting in 2017 all the way to 2021. We see that inflation was around 2% for the past 2 years. From 2017 and 2018. It was around 2%, and that's healthy. That's what we like to see as not only investors, but as economists. 2020, just like prices, the market tanked and inflation dropped to almost nothing. And over time, as our economy rebounded, keep in mind, 2020 was the shortest bear market we have ever had. It lasted less than a month, which is ridiculous. So we recovered pretty quickly from the COVID slump, and inflation has taken off ever since. Let's zoom in on this last little section and see what's happened just in 2021, because it's insane what we've seen. January of 2021, inflation was 1.4%. By April, it was 4.2%. By June, it was 5.4%. And by November, it was almost 7%. The reason is the Federal Reserve really wanted us to spend money. It's how we keep the economy healthy. So they started throwing a bunch of money into the market, devaluing what a dollar is worth, encouraging us to go and spend. So here's the thing. Not all industries felt this. 2 industries definitely did, one of which, just like I mentioned with the Chipotle index, the price of my Chipotle burrito went up quite a bit. But the other thing that went up a lot in price was energy. Energy saw the largest inflation in 2021. How much? Well, energy itself saw 33.3% price increase in 2021. Gasoline, 58.1%. Natural gas, 25.1%. And electricity, 6.5%. Compare all of these numbers now to the market average. So if we took all industries together, we would see the average inflation rate was 6.8%. So gas prices were over 7 times higher inflation than the market average. It's a good time to have an electric car. All of this data, by the way, is from the Bureau of Labor Statistics. They have some fantastic data on the prices of different goods, and they even have 2 different inflation numbers. One that's everything, and then one excluding food and energy, because of how inflated those 2 areas in the market specifically were. I want to buy Chipotle stock, so I know I'm contributing to my own company. $2 plus for a piece of avocado. Oh, I know, but oh, is it worth it? Again, not a sponsor. Sponsor me. So now let's go on and look at sector ETF price changes. I didn't want to get too far into the weeds with this because you're going to see a lot about price changes today, but I wanted to have one family picture with all of the ETFs across the entire year. So, ta-da, here you go. What you're seeing here is from the first of the month to the first of the next month. How much did the price of that ETF change? So we see here January, February, March, April, May, June, so on and so forth. And then at the very end is the 1 year change. This is how much have the prices changed from January 1st to December 20th of 2021. And again, I'm not going to get too crazy into this, but I want to highlight a few very interesting months here. January, everything was pretty middled. There were a lot of things that went down and a few things that went up, namely energy. And energy became an even bigger topic in February when it went up by 24% in a single month. We'll talk about why in a couple minutes. Moving forward, March and April, hysterically good months. We started to see widespread vaccinations. Things began to look very optimistic, and investors like optimism. So March and April were huge. March only saw energy with a negative 0.3% change. April, every single ETF enjoyed benefits. Moving right along, we see that July saw some pullback for energy, but the big, very red mark on this entire scorecard here is September. September, everything suffered, except for one, energy. Energy in September and October led the market by a mile. Again, we'll get into why in a little bit. But what I really want to show here is one thing in particular. Even in the worst of months, September was one of the worst Septembers we've seen in years. Historically, it's always been a bad month, and if you're interested to learn about why, I do have a webinar on that exact topic. So, not going to get into that right now, but historically, September is pretty bad. Septembers after election years, even worse. This year was no exception. But energy was the bull market. So what I want to show here is one thing and one thing alone. If this is all you take away from it, great. This is the point of the presentation. There's always a bull market somewhere. Simple as that. There is always a part of the market that is not, I wouldn't say, it's not going to set you up for retirement, but it's going to be stable or it's going to provide positive returns. So here you see that. Even in the worst of months, one sector at least was enjoying some price improvements. But the most important thing of all is by the end of the year, every single ETF saw an increase in price. Over the entire year, we enjoyed record after record after record highs for the SPY, for the New York Stock Exchange, and for the NASDAQ. It was a crazy year of growth in the market, and we see that here. Yeah, energy got hit pretty hard in some months, but the fact of the matter is, it still ended 43.7%. So if you had invested in XLE at the beginning of the year, put yourself in a little fridge and decided, okay, wake me up at the end of the year, congratulations, you would have made 43.7% return. Even in the worst of sectors, you're still making 12.6% return. All of these are above the inflation. SPY, which is the average of it all, or really is what everything sits inside of, let's say, it's the weighted average, is 23%. So had you invested in SPY and nothing else, you would have made 23%. If you're interested to see what you could have done with Sectors Made Simple, back-tested strategies, go take a look at Friday's webinar. We beat the SPY by over double, which is impressive. So all of the prices, now again, we've gotten the family picture done. Now let's go and talk to all the grandkids. Let's go and look at relative strength. So how are we going to do this? We're going to go month by month. Starting with January, we're going to look at the matrix on the 1st of January. Then we're going to cover major world events in January, look at the largest sector ETF price changes, both improvements and losses. Then we're going to start that entire process over for the next month, looking at February 1st. Let's get into it, because there are 12 months for us to go through. I will go through this pretty quickly, so there is a lot of months for us to cover. I don't want us to get worried about taking notes on every little thing or whatever you try and do to remember this. All I'm trying to show here is that things happen in the world, and the stock market often reacts to whatever's happening. A lot of the times, it's very easy to draw a comparison. Other times, not so much. World events are only one condition of the entire market. There are thousands of different reasons that the market does what it does every day. The point of this is just to show changes over time in both sector relative strength and also those monthly price changes. So without any further ado, let's get started with January. This is what the matrix looked like moving into 2021 on January 1st. We have technology as our sector leader, XLK, with a total of 20. For those playing along at home that want to know what these numbers mean, we use point and figure charts. It kind of looks like a mad game of tic-tac-toe with a really big grid. But what it tracks is two main things: direction, which is a column of X's going up or a column of O's going down, and positive and negative trends. So what we do is we compare every single day. We compare every ETF against each other, 132 charts in total. And we add up how many of those charts are in X's and are in positives. X count is our short-term indicator. The higher the X count, the higher the short-term strength. Positive trend is our long-term indicator. The higher the positive trend, the higher the long-term relative strength. We add them together to get the total count, overall relative strength. So all of the charts you're going to see today are taken from our matrix, the relative strength matrix. It is our main thing, and it is great. So for those that are interested, this is what the matrix looks like. Every single day, you get a new matrix. So we're just going to be highlighting the matrices from specific days throughout the year. So this was the matrix from January 1st, and we see technology, the technology sector represented by the ticker symbol XLK, as our sector leader with a total count of 20. The highest score you can have is 22, the lowest score you can have is 0, and an average is 11. So here what we see is technology is our leader, communications is second, materials is third. Now, let's look at what actually happened in January. We started off the year with the Capitol Hill riots and the attack on the Capitol building. Then we had the presidential inauguration later on that month, And looking at the stock market as well, we had the good old GameStop squeeze. We talked about short selling, we talked about what a short squeeze is, and we saw GameStop hit some pretty ridiculous numbers. And then tank, and then skyrocket again, and then tank. And we learned the real power of the internet being able to take a stock and say, all right, let's blow this thing up. Let's see how high we can make this price go. And from GameStop, we learned they can make it go pretty high when the market conditions are right. If you're interested to learn more, we do have 2 webinars on short squeezes and on the GameStop situation. Looking at sector price changes, we saw that the biggest gains for the month were energy and discretionary, with 3.3 and 2.7%. Real estate close behind with 2.6%, and staples was the biggest loser for the month with 4.9% loss. That then brings us to February of 2021. Technologies was our sector leader with an overall count of 20. It lost 6 compared to January, slipping down to a total of 14, tied for 3rd place. But with a weaker X count, a weaker short-term momentum. So it still had some of its long-term strength. It takes more for it to lose that. But the short-term strength definitely had dropped quite a bit. But the other thing that we saw was that average sector relative strength decreased quite a bit. Whereas last month we had leaders with 20 and second place with 18 total counts. Here we're seeing our leaders are 15s and 14s. Definitely not the overwhelming leaders like we had the previous month. Then February, there was some pretty large world events that happened. We had the military coup in Myanmar, and then domestically, we had New Jersey decriminalizing marijuana, and major power outages across Texas as a result of the winter storm that hit the state. Also, this month saw the authorization from the FDA for the use of the Johnson & Johnson COVID vaccine. So how did these translate to sectors? Well, like I said before, much of the sector changes that we see are the result of real-world events. That major power outage, you bet that had an influence on energy. Energy skyrocketed 24.1%. Financials went up by 13.8%. Communications up by 8.8%. And utilities was the hardest hit. Go figure, when there's a power issue, the utilities providers are going to be the ones that foot the bill. Yeah, utilities got hit the hardest with 4.6% loss. Then that brings us to March of 2021. We see that while discretionary, our previous sector leaders slipped just a little bit in relative strength, energy and communications had huge 1-month changes, what we call momentum. It's our way of saying what has changed from one matrix to another. Our 1-month momentum changed significantly, where our leaders were last month 15s and 14s. Now we see 19 and 18 as our 2 sector leaders. Communications, XLC, and energy, XLE. Go figure, if we look over here, it's 2 of the sectors that saw the biggest price changes. Another thing I want to note here, though, is financials. Financials did see a 13%, almost 14% price increase. But that alone was not enough for it to gain sector leadership. If all we were looking at was price, then yes. But relative strength is just that, relative. If we look back 1 month, financials was at 11. Looking forward, it's at 15. So yes, it gained strength. Oops, that's the very end of the presentation. No spoilers. I apologize for that. That's January, and that's March. There we go. So this is what happens when your arrow key to go to the next slide is also right next to the go to the very last slide. That whoever designs keyboards messing me up here. I blame them, not my own mistake. So again, discretionary and financials both improved, but not enough. Because it's not just about being the best this month. It oftentimes comes down to what was the relative strength like the previous month, and then how much has it improved. Now, that's not always going to be the case. We'll see here in a little bit that some sectors have seen massive single month swings. But for the most part, sector relative strength is something that changes a little bit more slowly. So let's now look at, also the last thing, utilities was the hardest hit sector this month in February. Utilities also hits a 1 on the total count, only holding on to a single positive trend. And if I remember correctly, it was against Staples, I believe. All right, March notable events. We had quite a bit happen. The US Senate passed a $1.9 trillion COVID relief bill to try and provide more aid to small businesses as well as individuals. Roblox, the video game company, issued an IPO that was valued at $45 billion. Then, on the global scale, we have two major events. One was the start of sanctions against China over human rights abuses. And the other was the Ever Given, that little boat that couldn't. And by that I mean it's the big boat that got stuck in the Suez Canal and caused massive disruptions in the global supply chain. Keep in mind that we rely on global communication and global transportation. It's very easy for Juan de los Palotes and myself to hop on an airplane and fly to a place. But for our packages, for any materials that need to go between countries, the main way it's still done is boat. We rely on massive container ships to transport everything that we rely on to enjoy as part of consumer life. All of that got put on hold when the Suez Canal, the connection between Europe and Asia, it's the canal that is in Egypt. And this giant tanker got stuck sideways, preventing other ships from passing. It caused a massive backup and billions of dollars in losses for companies. So when that happened, the market was not too happy for a day or two, and very quickly got over it. So March was basically, for the most part, pretty good. Only a single sector saw a loss of 0.3%. Every single other sector, saw gains. The biggest improvements were utilities with 8.3%, industrials 7.5%, and materials 6.7%. Again, what's fascinating here is that industrials and materials are two industries that rely on global supply chain. The fact that they improved in value is fascinating. It goes to show that when a world event happens, it doesn't mean that the affected industries are going to tank. Same way as when the Texas winter storm and ensuing power outages happened, energy still went up. So it's very interesting to see how global events sometimes can yield negative results for the market and other times positive results. April. We get now to April 1st, where I like to call this the middling. no longer do we have our 19s and 18s, or even our 15s. We have 114, 113, and 7-Elevens. Once again, not a sponsor. We see 7 different sectors, all holding 11 in total count. Most holding on to a lot of short-term momentum. But the biggest change that we saw in this month was energy. The energy sector tanked from 18 to 4 total count in a single month. Communications also got hit incredibly hard, losing 8. Now, I want to go back and show something. Every sector saw price improvements or no change. Energy saw a drop of 14 in relative strength. Communications saw a loss of 8. Again, this goes back to what I was talking about, where relative strength and price changes are not the same thing. Everything can be going up, and relative strength can still have massive gains, or in this case, massive losses. They are not correlated. Just because there is big losses doesn't mean there's going to be big relative strength losses. Relative strength is relative. It compares two things against each other. If both of those things are going up, we're not going to have any relative strength change. Relative strength change only happens when one is now changing its balance against the other. So, April was an interesting month in the market. Alibaba was hit with a near $3 billion fine over antitrust laws and monopoly laws. Then the US announced their withdrawal from Afghanistan, which we'll talk about a little bit more later on. And one of the biggest news for the stock market was Coinbase, which is one of the largest, if not the largest, cryptocurrency exchange. It is the New York Stock Exchange for cryptocurrencies. Began trading shares on the New York Stock Exchange. It was a massive move for crypto that also established cryptocurrency as a legitimate form of currency, as a legitimate industry, and brought it some legitimacy. And it's really cool to see. Crypto has its benefits and its drawbacks, and again, I have a webinar on cryptocurrency and why it matters. But this was a big move. This was a really big confirmation that crypto is here to stay and that these exchanges are extremely large companies, with some of them even getting listed as stocks on the New York Stock Exchange. Now, big changes for sectors. We saw another month of, this month actually, universal improvements. Every single month, or every single ETF saw gains. The biggest changes were real estate and financials with 7.2%, and materials once again with 6.8%. That brings us to May of this year, where we saw an overall improvement in relative strength. Gone is 7-Eleven, and in its place, we have seen financials and communications rise as our sector leaders, alongside materials in third place. Now, financials, once again, was doing well before and has continued to do well moving into May. So, what did May bring us? First and foremost, the EPA, the Environmental Protection Agency of the United States, issued a limit. This is not a regulation. This didn't say, from today on, we have this announcement. It was, we have plans to limit our use of what are called HFCs, or hydrofluorocarbons. It is a byproduct that is created and is a very harmful compound for the environment. So this move was a move towards cleaner energy and cleaner sources of power. In addition, the FDA, the Food and Drug Administration of America, approved Pfizer's COVID vaccines for use in 12 and 15-year-olds. And lastly, for the first time in over a year, the CDC lifted mask mandates for vaccinated peoples, a huge milestone in our progress against, or through this pandemic, I should say. Now, big changes for sectors here. Notably, the energy market responded pretty well to this limit on hydrofluorocarbons, so energy took off at 8.5% return. Materials, once again, 5.7%. Financials, 4.5%. And the hardest hit sector was discretionary at 4.1%. This started to create a matter of a very interesting topic. Building materials were getting expensive. Partially due to global supply chain, partially due to supply over the pandemic, and then partially due to the increasing demand for lumber and other materials. Again, I do have a webinar on the building materials industry that goes into a lot more detail on this topic, so if you're interested, go take a look. That video is available on our YouTube channel for free to watch. And that takes us through the end of May. June 1st, very little change in the world of top sectors, very similar spread of relative strength. I'm not here to try and create news when there is no news, I'm just here to report on the changes when there are them. So, what changed in June? Following the CDC's guidelines, New York and many other states fully lifted COVID-19 restrictions, limiting the amount of people that can be in the same space, limiting if you need to wear a mask indoors in most locations. Hospitals and other critical care locations still had those mandates. And on the less good side of the pandemic, the Delta variant was discovered and sequenced, and the spread started to be followed. Lastly, Mexico decriminalizes marijuana, and that's the big news. And if you've noticed, this topic of marijuana has come up multiple times. The reason is it was an incredibly volatile industry in 2021. When President Biden was elected, there were many people in the United States that expected part of his plan for his 4 years in presidency was to decriminalize or fully legalize marijuana on a federal level. That has not happened. That's not something that's even been discussed recently. But what has been discussed and what has happened in the last year or so is legalization in Canada, decriminalization in many states, and Mexico decriminalizing as well. It is not the US, and it's not going to have a direct impact on the US market. However, this is an industry that is here, is available in the United States, and is investable in the United States. So it is a huge topic that is, yes, incredibly volatile, but as we start to see restrictions and acceptance in other countries begin, the US is going to follow suit at some point, is likely, going to follow suit at some point. And if it does, those marijuana or cannabis-related companies and ETFs are going to see the largest improvement. So while it's not news right now, I do want to talk about this as ongoing events because it affects North America. Canada's policy and Mexico's policies, while they don't directly impact the US, are considerations when it comes to US domestic policy. So that's why you're going to see this topic appear a couple times. Now, big changes for sectors in this month. Technology. We see some of those more volatile, those more sensitive sectors start to take off here. Technology enjoyed 6.4%. Discretionary 3.3%. Meanwhile, communications dropped down 3.6. So it wasn't a universal improvement, but some of these more sensitive sectors began to recover. When the market improves, we're going to see those offensive sectors take the spotlight. When we move through to less positive or more defensive markets, of course, those defensive sectors are going to come to the forefront. So that brings us now to July 1st. We see our offensive sectors take leadership. Technology, communications, and discretionary are the three sector leaders alongside the S&P 500 itself. Meanwhile, utilities bottoms out at a total count of 0. 0, 0, 0 across the board. And materials, one of our previous sector leaders, drops 8. Loses half of its relative strength in a single month, bringing it down to a total of 8. In July, we had a couple of major events, including record heat and fires across the western coast of the US, the UK following suit with the US lifting COVID restrictions, and the Olympics beginning in Japan without audiences. Big changes for sectors, healthcare and utilities, finally some good news for utilities, went up by 5%, real estate by 4.7%, technology by 3.7%, and the big loser for the month was energy with a loss of 11%. Now, moving through to August, we have some more changes. We see a slight dip in overall relative strength, while utilities, as a result of its improvements, begins to bounce back, gaining +6 in total count, with a decent spread, with mostly long-term strength and some short-term strength as well. SPY, despite going up 2%, loses 4 in its total count, dropping down to a total of 12. Meanwhile, communication weakens and gives up leadership towards real estate and healthcare, two of those big winners on the month. Moving through to August, we have fire season on the West Coast continue, with the Dixie Fire burning 963,000 acres over the course of a few weeks. Heat waves continued, causing strains on the energy sector, and the first booster shots for Moderna and Pfizer were approved by the FDA. And this month also saw the withdrawal from Afghanistan of US troops. Big changes for sectors, utilities and real estate saw 5 and 4% changes respectively. Communications saw 4%, and as a result of that heat wave, the energy sector dropped by 3.5%. Which brings us now to September. Most sectors in September saw relative strength losses, with technology holding on to sector leadership and discretionary seeing a -5 change, dropping into the bottom half of the matrix. Meanwhile, utilities that 2 months ago had 0, 0, 0 continues to gain not just long-term relative strength, but short-term relative strength as well, bringing it up 7 to the 4th highest sector overall. Now, September had some pretty large events as it relates to the market. The US, as a continuation of the HFC conversation from earlier, sets a goal for 44% of American power to be solar by 2050, as well as the UN had a meeting that resulted in a global commitment to climate change, with some more resilient members, such as China, even agreeing to limit their coal usage in the future. Then we started off the year with the Ever Given, and we end the year with the Evergrande, a Chinese real estate company that was the second largest real estate company in China, was the 152nd largest company in the world, failing to meet bond payments, starting its spiral towards bankruptcy and indebtedness. Again, if you're interested for that topic, I do have a webinar all about the Evergrande situation. Domestically, we had one very large change made to our economy: federal enhanced unemployment benefits. During the pandemic, the government issued enhanced unemployment, giving us extra money for those that lost their jobs due to COVID or need to still pay bills. That ended. In September, the enhanced unemployment benefits ended while the Federal Reserve began conversations about, remember how we talked before about the Fed throwing a lot of money into the market? They started talking about taking that money back out. And the market was not too pleased about it. As a result, all but one sector saw heavy losses in September, with energy being the only winner with 11.9%, financials with a loss of 0.3%, utilities 8.2%, real estate 7.5%. Which brings us now to October. Financials, despite losing in September, did see a +7 change in relative strength, bringing it up to the highest overall strength sector. Technology was hit pretty hard, losing 6, dropping it to 12 overall, while energy saw a ridiculous +13 momentum change in 1 month, becoming the second strongest sector overall. October is where things get a little interesting, because after the craziness that was September, the market bounced back pretty strong in October. Digital World Acquisition Corp, DWAC, was a organization, a capital management group that was listed on the New York Stock Exchange during 2021 in October. Many of you might be familiar with it. For those that aren't, it is sponsored and is in benefit of Donald Trump and is an effort for him to increase capital and create a platform for him to be able to share his thoughts and create stations and resources for that kind of conversation. Additionally, inflation spikes as energy prices skyrocket to a peak. This right here is that massive 58% that we were talking about before with gasoline and natural gas prices. This is where a lot of that kind of hit its climax. So the big changes for sectors were the discretionary sector taking off with 13% increase. Energy, 7.4, technology, 7.0, and real estate, 6.9. Moving on to November, we see that most sectors saw moderate positive changes over the month. Technology bounced back, re-entering the top 3 sectors, and discretionary saw a +5 change as well. Now, November notable events included Rivian, the electric car maker, IPOing, and Tesla dropping the same day by over 10%. Additionally, the Federal Reserve confirmed what many of us believed, that they plan to taper off their bond buying and start to put many of those bonds back into the market. Bond buying and selling is how the Fed manages cash. So them saying that they're going to taper bond buying means they're going to slow how many bonds they're buying, they're going to stop putting money in, and start selling some of those bonds back, taking some cash and just sitting on it. That is going to cause inflation to drop. Additionally, President Biden signed a $1 trillion U.S. infrastructure bill. Additionally, earnings season came around. For many publicly listed companies, November saw them announcing their Q3 earnings. And to say that those earnings calls were good is an absolute understatement, as there's a lot of people whose career it is to tell us what to expect from these earning calls. And when a company beats analyst estimates is a really good sign. This year ranked in the top 5 periods that there's been since 1970, I believe, of companies outperforming estimates. So as a result, we saw some decent price changes, technology improving by 3%, discretionary as a result of Tesla, one of the largest discretionary companies, dropping, brought the sector down 1.2%, energy correcting back down 7.1%, and communications hit the hardest, 8.7% loss. We're getting to the very end of things here. With December 1st, technology reaches the highest total count possible on the matrix, with a total count of 22. Meanwhile, average sector relative strength reached its highest point all year. December, mostly bad news, but not all terrible. Omicron, the new COVID variant, was identified, sequenced from South Africa, and has begun to spread in the US. Some European countries have already announced lockdowns, and many more have announced plans to restrict transport or travel during the holidays. Also, Evergrande, that Chinese real estate company, declared indebtedness and is working with the Chinese government to find a way to recoup investors, both of real estate and of capital. Additionally, Alibaba, the Chinese company we mentioned before that got hit with a $2 billion fine, delisted from the New York Stock Exchange. Sector changes, we see a stark shift from very offensive sectors to very defensive sectors, as volatility has skyrocketed as a result of the confusion around this new COVID variant. So staples, my apologies, 6.4%, healthcare 5.5%, utilities 5.3%, and discretionary, an offensive sector, losing 4.9%. Which brings us to today's matrix. Gone is technology, gone are the 20s and 22s on the matrix. In its place are defensive sectors. Real estate kind of can do whatever it wants, but is currently the sector leader, tied with staples at a total count of 14, with a tie for third between healthcare and materials. So what can we take away from 2021, and why have I just gone through so much detail? I wanted to illustrate the fact that market volatility has been high throughout the year, and that volatility is the result of uncertainty. But the fact of the matter is, even in the worst of months like September, there's still a bull market somewhere. So yes, December's been a crazy month as countries try and figure out how much of a concern Omicron will be. And that is one of the largest considerations moving into 2022. But there are some other ones that I want to mention as well. As a result of the new regulations, we might see more Chinese companies follow Alibaba and move from the New York Stock Exchange over to the Hong Kong Exchange. We are also currently seeing a shift towards defensive sectors such as staples, utilities, and healthcare, which is an indication that investors are getting a little bit more defensive, a little safer, as the market tries to figure out what Omicron might really mean for the global economy. These price shifts that we've seen are backed up in major changes in relative strength and are well worth keeping an eye on moving into the new year. So, that was 2021 in the world of sector rotation. There was a lot because a year is a lot of time for the market to change. But it's been a pleasure to get to be here alongside all of you, experiencing and living these changes in real time and getting to talk about many of the largest events as they unfolded. If any of these events were interesting to you, go check our YouTube channel, because chances are, if there was a big event, we have a webinar on that topic where we cover what happened, why it happened, and how it relates to the market. And 2021 is a wrap. Thank you all so much for enjoying these webinars, participating, whether you join us for every webinar, whether you just read our newsletters, or you watch the recordings. It's a pleasure to get to provide you all information to help you invest with confidence. And after all, this is Sectors Made Simple, so we help you to invest simpler. Thank you all so much. We have an amazing amount of new projects coming up for you all in January. So if you're interested to learn more about what we're doing here at Sectors Made Simple for the new year, take a look at last Friday's webinar all about Sectors Made Simple 2021 review. This is the last webinar of the year, so I wish you all a very Merry Christmas, Happy Holidays, and a fantastic and safe New Year. We'll see you all back in January for our next members webinar, which will be on January 4th of 2022, and our next free webinar for everyone available on January 7th of 2022. So until then, thank you all very much. Happy holidays, and we'll see you all very soon. Take care.